All right, let's dive into the latest earnings report from insurance broker Brown & Brown. That's ticker BRO. Now, on the surface, the numbers looked absolutely fantastic, but then the stock just dropped like a rock. We're going to unpack exactly why this happened, because it's a classic case of good news is actually bad news.
And this right here, this is the whole puzzle in a nutshell. On one side, you've got this massive beat, earnings up over 15%, revenue just soaring more than 35%. I mean, that's textbook stuff, right? But then you look at the market's reaction on the other side, a pretty brutal sell-off with the stock down over 6%. So what on earth did the market see that the headlines completely missed?
Okay, so before we really dig into what spooked everybody, we've got to give credit where it's due. Those headline numbers were seriously strong. I mean, Brown & Brown didn't just squeak by Wall Street's expectations, they pretty much blew them out of the water.
First up, let's talk about the bottom line. The company delivered adjusted earnings per share of $1.05. Analysts were expecting something way closer to 90 cents. So this isn't just a beat, it's a nearly 17% beat. That's a huge surprise to the upside.
And it was the exact same story on the top line, the revenue. It came in over $1.6 billion for the quarter. Now that is a staggering 35% increase year over year, and it was comfortably ahead of what everyone was predicting. So far, so good, right? Well, this is where the story starts to get a little more complicated.
And here it is. This chart shows you the first major red flag. That 35% total revenue growth, it looks incredible. But then you look at the bar right next to it, the organic growth, and that's the really important stuff. The growth from their core existing business was only 3.5%. The rest of it, that was all from acquisitions. And this huge gap is what started to make investors really nervous. So that brings us to the second major issue here. The market is always looking forward, right? It looks straight past those big headline numbers and focused on the future. And what they heard from management's guidance, well, that's what really pulled the trigger on the sell-off.
And when you start breaking down that already slow organic growth, it gets even more concerning. You can see here the company's core retail segment grew at just 2.7% organically. And get this, management even said that number was helped by a few one-time things. For a business that's valued on steady, consistent growth, this was a serious problem.
And this quote right here from the earnings call, this is basically the smoking gun. This wasn't some analyst's pessimistic forecast. This was management itself, telling everyone to expect a potential decline in organic growth for a key business segment next quarter. When you guide to a negative number after an already weak quarter, yeah, that's a recipe for a sell-off.
And look, this wasn't just some vague, cautious feeling. Management pointed to very specific problems coming up in the next quarter. They're facing tough comparisons against last year, they've got ongoing rate pressures, and they're seeing slower growth in some key areas. In other words, the path ahead looks pretty challenging.
Now, to really understand that huge gap we saw between total growth and organic growth, we have to talk about the massive strategic pivot that Brown & Brown is in the middle of right now. This giant acquisition, it's the whole other side of the story.
The main reason for that huge 35% revenue growth was this nearly $10 billion acquisition of a company called Accession. The deal just closed, so the third quarter was the first time we saw its massive impact on the numbers. And believe me, it is completely transforming the company's entire financial profile. So what's the logic behind a blockbuster deal like this? Well, it's pretty simple on paper. Acquire a ton of scale, integrate thousands of new employees, and then drive growth through synergies. It's a massive bet to quickly bulk up their specialty businesses. But while the goal is long-term growth, an integration of this size, it comes with enormous risk.
So let's recap. We've got record headline numbers being driven by a huge acquisition, but we've got a core business that's slowing down and a tough quarter on the horizon. It's time to put it all together and make a call on the stock. This is the next call.
So where do we go from here? I mean, is this a classic case of some short-term pain for some really big long-term gain? Or is that organic slowdown a sign of deeper issues, that this big acquisition is just kind of papering over?
After weighing this massive strategic shift against the very real near-term challenges they're facing, we've landed on our rating. We believe the stock is likely to
market perform. We think the stock is probably going to perform right in line with the broader market from here. You've just got too many conflicting signals. This huge inorganic growth on one hand versus that weak organic guidance on the other. It creates a really balanced risk-reward profile that just makes it tough to be either super bullish or super bearish right now.
And our thinking here is pretty straightforward.
You see, the Accession deal provides this powerful new engine for revenue, which is great, but you just can't ignore the sputtering of the old engine. That slowdown in organic growth is real. Management's own guidance basically puts a cap on any near-term excitement, and let's be honest, the risk of messing up an integration of a deal this size is monumental.
Okay, so how do you trade a stock that's likely to just go sideways for a while? Well, for anyone who already owns the shares, a covered call strategy makes a lot of sense. The idea is that all these headwinds are probably going to cap the stock's upside in the short term. So by selling out of the money call options against your shares, you can actually generate some income while you wait for the company to prove it can pull off this integration and get that organic growth engine started again. It's kind of the perfect strategy for a wait-and-see stock.
And of course, just a quick reminder, this is not financial advice.